how much that jobs report tomorrow really matters to this bull market. It still is a bull market. Let's ask Ann Sonders, Schwab's chief investment strategist. Welcome back. It's nice to see you.
Nice to see you too, Scott. Thanks for having me.
Still a bull market, but man, whew, it doesn't feel like one these last few days, does it?
Well, it's a bull market at the index level, although you did have a correction in the NASDAQ. But using the NASDAQ as an example, even at the all-time high, you had more than 40% of the stocks within the NASDAQ, or the average member maximum drawdown was 40%. Right now, it's even 18% for the S&P 500. So there's been a lot of weakness and churn and rotation under the surface. It's just masked by the cap-weighted index return. So we've had bear market level declines, and that in turn, I think, was the setup for some of the broadening out that we've seen, and the fact that there was money that wanted to take advantage of some of that weakness under the surface. So there's a lot more to the story than just what you see at the index level.
When people ask you what's going on here, or what your view of the market is in the here and now, how are you answering that question?
Well, it depends on what you mean by the market. I think this broadening out has legs. Notwithstanding a day like today, where the growth trio of sectors, consumer discretionary, communication services, and tech, are doing well again, you do see a little bit of that exhaustion in that mega cap tech trade, and the broadening out with equal weight trading at an all-time high, more action down the cap spectrum. What we are saying, though, to investors is you want to make sure you don't have similar concentration to what exists in the indexes. You don't need to perform well. I think that's one of the biggest misperceptions out there, is that for the individual investor, the only way for them to perform well is to be in those mega cap names in size. That's more of an institutional problem that may be running a fund benchmark to these cap weighted indexes. It's not the case for individual investors. Of the top 10 best performing stocks in the S&P, only one of them is in the Magnificent Seven. Not a single one of the 10 best performers in the NASDAQ is in the Magnificent Seven. So there are a lot of opportunities. What we are saying, though, looking for those opportunities outside of that small handful of mega cap names, you want to stay up in quality. That may seem like the ultimate duh statement, but there are times where you want to go down the quality spectrum, leveraging an upturn in the economy. We clearly don't think that's where we are in the cycle. So staying up in quality with profitability and return on equity and cash flow, that's how we've been telling investors to navigate this unique market.
But let's be clear here. When you say this broadening has legs, then clearly you must think that this is a growth scare, not a growth problem.
Right now, it is a growth scare. I don't think a traditional NBER declared recession seems to be in the cards. That said, you and I have talked about on this program many times, we've had these rolling recessions going back to the early part of the pandemic, where you had recessions, maybe haven't even clawed yourself out in areas like certain segments of manufacturing and housing related, and some consumer-oriented products. You just had the later offsetting strength on the services side. We saw some hope that manufacturing was going to pull itself out of its, using the ISM index, sub 50 readings. That was false-lived. That ticked back down again, but we still have the offsetting strength on services. So it looks like we may still have this roll-through scenario where you've got that offset on services that keeps the NBER from, kind of waving the flag and saying traditional recession. But the economy is slowing here, and the labor market really holds the key as to further slowing, especially through the confidence channels into the consumption side of the economy. I think that the holdup in consumption is not about savings or the savings rate. Excess saving is largely worn down. The savings rate is under 3% right now. It's that confidence in the labor market. If we see more than just the cracks we've started to see, I think that could feed itself into weakness on the consumption side of the economy, which has been hanging in there.